Are you a real estate investor looking to sharpen your skills or a newbie looking to become one? You're in the right place. Welcome to Where Should I Invest? Real Estate Investing in Canada with your host, Sarah Larby.
Myron, welcome to the show. How are you?
I am doing well, Sarah. Good morning. How's your day going so far?
It's going well. I'm actually at my cottage,
Nice.
in Lakefield, and I basically move from May, and I come back in September, and then I'll go back to Oakville like one day or maybe two a week. So this is kind of like my summer, how I disconnect as much as possible. What about you?
Yeah, no, so far so good. I'm in downtown Toronto right now. I know the past couple of days weather's been kind of gloomy, so I've got some sunlight today, but trying to enjoy this downtown summer weather, hopefully. So just excited for that.
Awesome, awesome. So remind me, did we meet at the Have Your Cake and Eat It Too retreat last year? Is that the first time we met?
We did. So I reached out to you, kind of getting more idea about the retreat, and with COVID, I've got to meet you personally. So I thought this would be a great way to kind of meet you and your team, kind of learn about the entire resort process. And trust me, probably one of the greatest experiences I had, like in terms of having a retreat outside our normal get together and networking session that we've had.
Awesome, awesome. Yeah, we're gonna do another one this year. But one of the really cool things, and this is how we started working together, I suppose, is that you're like, I just appraised another resort not that far from here. And I don't know, the resort and the amount that you basically appraised it for. I'm like, oh, this is pretty good. I wonder what we would get once we're done, at least phase one. And
Right.
then I guess fast forward to 2023, we had you and your team appraise our little resorts. And so thank you
Of
for that.
course.
So we can definitely talk about a little bit about that because that's what you do
Yeah.
for a living.
Yes. So I'm a commercial appraiser by trade. I'm an AIC candidate, so I'm still working toward my license to complete my license, but I do get to bring in my own clients, do the business development aspect of it, and I work with a team that are fully certified AECI, and they review the reports and make sure that they meet the market fundamentals and the assumption for values is as reasonable as from an appraisal standpoint.
So there's obviously, appraisals that happen for residential properties, which I'm sure many of us are familiar with, right? Like you're basically
Right.
comparing it based on market comparables, whether it's a house, a duplex, 3 or 4 units, et cetera. It's based on a few different things. But
Right.
when you get into the commercial realm, I feel like it's a lot more complex to appraise at that point.
Yeah, for me specifically, especially since I do have my own real estate portfolio myself, I find commercial a bit more um, easier in terms of understanding what the value potential would be, strictly because it's an income potential game. So you can provide a pro forma in terms of the expected rent you're able to achieve, the operating expenses, and kind of get an idea in terms of where that value would be. Whereas on the residential side, it's really based on transactional comps, right? So like if property's on your street, one person selling it way below market value can kind of deter and start a trend, especially on the residential side of the business. So for me, for clients that I deal with, they do prefer commercial. And also from a financing standpoint, there are a lot of benefits to that compared to the residential aspect of the game.
Okay, so because there's to me, I mean, to you it's easy, but for me it still feels more complex, I suppose. Because there's so many different things, right? Like, I mean, a resort is
Right,
completely different than a building. It's completely different than a mixed use building. So, like, what are some
right.
things maybe that you could share with the audience on like what you actually look for when you're appraising a commercial property? And then if you want to go into the silos, we could do that as well.
Yeah, of course. So I'll start with multifamily because that's majority of the clientele. I'm sure the listeners are in the multifamily aspect of the game, but ideally class C multifamily buildings, older buildings, limited amenities. Those buildings typically are being sold at a lower cap rate. So how the cap rate system works, that the lower the cap rate typically means the higher the potential of the building. From not saying that's what's going to happen because every buyer may overpay, but ideally the lower the cap rate means that there's more potential on the building, whereas the higher the cap rate, the limited potential on the building. The reason for that is as an investor, they wouldn't want to purchase a property that is fully stabilized because then their capital and their investment into the building is quite limited in terms of how much the return that they're going to get. So a cap rate is essentially what that return would be if you were to buy that property in cash. So we don't look at debt servicing. We don't look at which lender you're using. We don't look at the interest rate. It really comes down to the net operating income of the building. So your rental income, there's laundry income, there's income for parking, storage. It could even be for signage. And then your operating expenses typically is property taxes, insurance, for sure, utilities. And that comes down to hydro. So if you have separate hydro meters, you may have hydro for common area. Then you have gas, water is typically what the landlord is responsible for. Newer construction, a lot of developers and landlords are making it plus utilities. So the tenants are responsible for all utilities, which means it's a lower risk to the actual owner of the building. And then you got like lawn care, snow removal, advertising, maintenance, payroll and benefits, and then management expense and repairs and maintenance. Now we also have vacancy as well, depending on which city you are. So vacancy is typically taken into consideration in to calculate the effective gross income. So I have a lot of clients who add vacancy as an operating expense, but it is the rental income minus you add all your income and then you take away the vacancy, and that ideally gets you your effective gross income, and you take that amount and you deduct all the operating expenses. So it's a
And that
big
gives you your net operating income at the end, essentially.
yes, right? And that net operating income, that is what an appraiser would use to determine, okay, like what the income of the building is. And then they would apply a cap rate. Now, a cap rate is where a lot of people kind of get confused that, okay, like, well, if you're, especially in a tertiary market or secondary market, there's only limited data. So a lot of national brokerage like CBRE, Cushman and Wakefield, Colliers, they have their own market data report in every region. So that's more of a benchmark. But what we typically do is we actually pull the cap rate of public data that is released, and we see, okay, like the property sold for like $1 million. What was the, and they'll post the cap rate on that. So we'll have an idea what the net operating income is. So we look at the net operating income of a building at a 4 cap, and let's say you're having net operating income that is $5,000 per unit more than what that comparable is. And then we see a trend that's pointing towards an upward of a cap rate. The appraiser will use their knowledge and their experience and their market data to determine, okay, what range they would be willing to apply. A lot of investors now are doing as complete and as is, especially for multifamily, because they're buying, the lenders are lending based on the potential, and they want to make sure that there's enough skin in the game to ensure that they will be able to pull their capital at the refinance. So we're doing a lot of as complete and as is. So there's a lot of ways that the growth in multifamily is substantial. Retail to residential conversions, I know you're doing a lot of those mixed use. So ideally, we are appraising based on the potential of the building, even though it is a mixed use. It's like we are looking at what the as complete is, and then we're kind of working our way backwards to see, okay, what is the true value of the building as is.
Yeah, I mean, I think it's pretty fascinating just because you could take something that, is completely empty and then create a value out of it and then after repair value. But you're right, like that's essentially what investors or lenders, I should say, want to see is they want to see when it's completed, what is this thing actually going to look like?
Yes, of course. And even with land too, so like flipping paper is a
Mm.
big thing in the commercial side. Like you can take a raw land, put it through site plan approval, and get a rezone to whatever you want to build to the highest and best use. A lot of people do feasibility studies. A lot of the brokerage, commercial real estate brokerages do feasibility analysis of the highest and best use. And you can sell that land to a developer based on its potential. Now you've got to kind of hold the property through that phase. Especially in Ontario, takes much longer to get a lot of approval. And then, so there's different values in different stages. So you can buy a property from like 100,000, it can shoot up to $1 million, depending on what the highest and best use of that property is.
Yeah, I mean, and that's a hurry up and wait game because it can be very, very lucrative, but you're waiting a
Yes,
long time for if you're changing zoning, you can do really well. But like you said, like you're
of
spending a lot
course.
of money, obviously, going through the process, and you're not on a timeline that usually you would want to be on. You're on the timeline of the city and the municipality, which sometimes can be like a very long time. Like we're talking like a couple of
Yes.
years.
Of course.
So, okay, so you've got that, and the cap rate, I think you kind of mentioned a little bit, like if you don't have a ton of cap rates or, like if you're in an area that is maybe growing, gentrifying, like, are you ever like, where are you getting your cap rate information from? And are you ever looking at like, the cap rate being different by the time that the exit happens? So like, here's an example. So maybe the right now the cap rate is 5.5. And then
Right.
you're projecting a increase or a decrease in the market. Like, do you change the cap rate on the exit for the after repair valuation?
Yes. So the after repair value would be a higher cap rate essentially than the current cap rate. Now, depending on the stabilization and renovation period, like the cap rates may change. So a lot of the properties that are being sold right now and the public data that are available. So we have a lot of national subscription as part of our commercial real estate brokerage that release a lot of public data. So we have access to those information. So we're not really using like, local real estate board information. We have access to those, but in terms of data, we have like data firms that provide those information. And the way we look at cap rates is, especially in a city where there's not much information, we may have to expand our searches to secondary and tertiary markets around that area. For example, like if you're doing something in Woodstock and there's only limited data in Woodstock, we may have to reach out to Guelph, London, maybe even Kitchener, Waterloo. But we do know that they are a superior market compared to Woodstock. So then we would do our adjustments as necessary. But a lot of the time, we do find information within cities, at least one or two comms. And a lot of the properties that are sold right now are technically under contract probably about 3 to 6 months ago, maybe even longer, because commercial properties typically have a longer closing date. So the data is lagged. So even though right now, for in the market, and we may see a trend at a 5% cap rate, like any properties that are being sold right now, we may not even have that information until 3 to 6 months from the road.
Got it.
So the data is lagged, but we are seeing a slight upward tick in cap rates. And if we are doing a 1 year stabilization renovation period, and we see that right now, cap rates are transacting at a 6% based on the net operating income of the building at that time, we may or may not put a slight upward adjustment on the cap rate just because we see where the market is going in terms of the interest rate.
So a higher cap rate, because I know sometimes like it's taken me a while to comprehend this, but a higher cap rate essentially would mean a lower after repair value. A lower cap rate would mean a higher price at the end. Yes or
Yes,
yes or no?
essentially. Yeah. So lower cap rate means a higher price. A higher the cap rate means lower the price, but that's on the purchase side. When it comes to like the value on the after repair value, it's the same thing. The lower the cap rate will increase the value of the building. But it really comes down to the net operating income. So if
Yeah.
I'm looking at a Class C building and a Class A building, a Class A building new construction, even though you're getting a high net operating income when it's fully renovated, it's a lower cap rate than a net operating income of a Class C building because it's a superior asset class in terms of quality the tenants are going to be able to achieve, as well as the construction, as well as it's just in terms of the amenities that are available. So, for example, if you're looking at retail, uh, an institutional client would be willing to spend a premium on a property that has a Shopper Drug Mart, a bank, or Class A tenant in that unit because it's just in terms of the tenant quality, in terms of their willingness to pay rent, right?
Mhm.
Those kind of institutional tenants are not going to be willing, like they're not going to fall back on their rent, right? Because they just have a lot of skin in the game. Whereas if you buy like a retail plaza with a lot of mom and pop stores where it's not at the great, like anything can happen, especially during COVID, a lot of these shops had to go into bankruptcy or they couldn't pay their rent. Whereas a lot of the institutional tenants
Mhm.
are able to do that. So same thing with the tenant class. We also look at the location and neighborhood. So if you're in a really rough neighborhood that hasn't been gentrified, and we have a comparable that is in an A location in that same city, ideally that's a slightly of a higher cap rate. But then we also look at what the rent, because typically, so in commercial versus residential, if you have like a duplex, an appraiser would walk in and look at the quality of the renovation. They will look at, hey, like, of course, countertops, what kind of flooring are you doing? What kind of lighting? And all the information that goes in. In commercial, especially in multifamily, the rent typically attracts the kind of quality of the renovation you get, right? So if you're in the high end of the rental market, it means that your quality of renovation and the quality of the building are able to attract tenants that are willing to pay that. So it is really an income-based valuation. We do sell comparison analysis too, but we're still looking at the NOI per unit of those sale comparison, because any still comparison, like people are not doing a still adjustment summary chart when they're looking at a commercial property. They're literally buying it based on the net operating income of the building.
Yeah, no, I mean, I think it's definitely important. And I think it's also important to also look at like what your exit looks like and use, your analysis as part of the due diligence. I mean, most lenders are going to require regardless an as is
Right.
and as complete appraisal. And also it doesn't cost $500, guys. It's like 3,000, right? So I mean, I don't know if you have
Yes.
a range, but like let's talk about that because like that's part of the due diligence process for many of us as we're buying non-residential assets, whether
Right.
it's a resort, multifamily, conversions of some sort, a commercial to
Right.
residential. But like, what are we talking about? Like 5, 6, $7,000?
If you're looking for an as is as complete, I'm probably looking at around the $5,000 range, depending on where the city is located in Ontario. But the important thing is that you can find a lot of appraisal shops that are on the low end of in the spectrum in the local market. So we're based out of Toronto, but majority of our clients are institutional clients. So like that's our main focus. So we like to provide our services. So it's like choosing a mortgage broker or a real estate agent. Like a real estate agent that's been able to provide you with opportunities, a mortgage broker that's willing to provide you with the relationship and the quality of lending possible. You're not really going to negotiate their brokerage fee or lending fee or even the real estate commission, right?
No,
Because
because
you're
it could
providing
be a
for
matter of like thousands of dollars that they can help you with versus
exactly.
like trying to nickel and dime for a grand off, you know?
Right. So, like, for us, it's the same thing. It's like we're not gonna change the value of the report just because you're paying more, like, ethically, that's not what's gonna
No, no.
happen.
Right.
But you're the service you're paying for is the communication. Like, you can give me a call at like, when you're making a purchase in an area and be like, "Hey, Myron, like, what are the cap rates are you seeing in that location?" So, it's not even just that phase when you're getting a report done, it's the access to an appraiser
Mhm.
before or after, you get a property under contract. And once you build that relationship, like, you're all that a lot of my clients are they're just a text message away. They're like, "Hey, can we schedule a call?" They're looking to buy in a new city, and then I'll just pull some data that we have, and it'll kind of be their consultant through their process. But I'm not really charging them for my time and consulting fee with all that information. But when we get to that point, it's just that the information that's available, like I'll take my clients out for, to a restaurant, we'll get some coffee and just build that relationship and see, hey, like, where are we looking to get to that portfolio, and how can we, in terms of how can I provide you with the market fundamentals to make an informed decision when you have to put an offer on a property? Because a real estate agent may only see one aspect of the game, and a lot of real estate agents are not investors themselves, and
Mhm.
they only know to the information they have. So I just want to make sure that we, as an appraiser at on an appraisal team, that does all of Canada. So I've done appraisal work in BC, Saskatchewan, did a lot in Alberta. I did two recently in Manitoba and Saskatchewan, and now we've started to do stuff in New Brunswick. So we're able to. It takes time to get familiar with a lot of information, but for sure, Ontario, like been up to, we flew to Thunder Bay, flew to Sault Ste. Marie. So there are clients that are willing to have us travel. Now it comes with a fee, but once you have a large substantial portfolio, a lot of clients don't really care about spending a few thousand just to get the appraiser out there. They rather have some comfort that, hey, through the appraisal process, they're going to have some guidance and some consulting throughout the entire phase.
Yeah. I mean, these are much higher ticket items, right? Once you get into the commercial multifamily space, conversion space, resort space,
Right.
that, it's definitely, I am a big relationship believer as well, that you've got to have a good expert team on on your side. And that can grow with you. And so,
Of course.
that's what I would rather have that and pay a little bit more than to have to chase somebody for weeks and weeks before I hear back from them. And so I think
Exactly.
that's important. So I guess you get to travel to some cool places ish.
Yeah,
Like
like
kinda.
I've walked through properties where I'm like, thanks, like I would never want to walk into this property again. So we try making sure, luckily a lot of our clients, they're pretty sophisticated to buy in good area and great location. But there are a few times where, we've had horror stories kind of walking in and, you have some in multifamily, you've got to deal with a tenant, right? A tenant doesn't really know what an appraiser is, right? Like they think there's somebody coming in taking pictures of their belongings, but we try our best to make the the phase as simple as possible, but we deal with tenants a lot.
Yeah, no, for sure. So, okay, so you're obviously in the commercial space now. Do you touch anything industrial?
Yes, we do a lot of industrial.
So let's talk about that because I don't think that's a category that many people play in yet. But I think it could be a very, very lucrative category
Of
for the
course.
right deal. But maybe just give us your thoughts. I mean, you're obviously a very savvy investor yourself, but give us your thoughts on like, that arm of things, and then just how you would appraise something, like that.
For sure. So in the pandemic, the two hottest asset classes were multifamily and industrial. Office and retail, depending on where it's located, had one of the biggest struggles through that phase. But with industrial, there is a lot of like changes happening right now. A lot of shops are moving into warehouses, like online where if you look at Amazon, like in terms of a lot of the orders that were being placed online, a lot of people got comfortable with online shopping, right? So if we're looking at the 401 corridor and we're just looking at straight down to Windsor, we're looking at the QEW straight down to St. Catharines, 410 straight up north, and then we got 427 straight up north. Like these are all like major highways, even 400. So a lot of the corridor along the line along those are pretty much where accessibility for truckers, right? And land is very limited for industrial development. So we were doing appraisals for a lot of our clients, institutional clients who had like, I'm talking about like hundreds of industrial properties across Ontario and Quebec and in Canada. And they were reaching up to a 2% cap rate, even a 3% cap rate, which is very, very low, right? But in Ontario, it's just the demand for what people are paying and even small business too. So industrial condos, we've seen a lot of people getting into industrial condo just because um, people just want to get away from the residential tenancy act,
So
right?
what is an industrial condo?
So let's say you walk into a plaza, right? So single story. For me, we'll talk about the GTA. So if you're looking in Mississauga and you're driving down and you see like a single story, all brick industrial building, you'll see like multiple shops. So they can be like different warehouses, and then they have a garage at their back. So they have like a clear height. That's something we take a look into in terms of valuation. We look at what the tenant lease structure, and the biggest thing a lot of people love with industrial is TMI, right? So the tenant is responsible for management, insurance, and then taxes, right? So if if you're a single tenant industrial building where you have one tenant, they're essentially responsible for all those expenses. And that's how the lease is structured. So from a landlord, you basically don't have much expenses other than the normal repairs and maintenance that are required based on the lease, and you're collecting rental income. Hence why the cap rate is low. So another thing with cap rate is it's a lower cap rate if it's less risk to the actual landlord. Same thing with multifamily. So if you have a tenant that, if you have a building that is structured that all utilities are responsible of the tenant and you have limited common area, then from a landlord standpoint, all they're doing is collecting rental income on that building. It's a high performing asset class. Same thing with industrial condos. It is a high performing asset class from the landlord's perspective, but a lot of industrial condos are typically owner user where someone looking to operate their business out of a shop, they want to use that facility as storage. And even moving into another sub-market within industrial is self-storage. A lot of people want to get away from the Residential Tenancy Act, where as you're on the commercial side, and it's simply where you just rent out the self-storage units and it has very minimal maintenance, and you're streamlining the system where you have the electronic gates. So they have the key fob. So you don't really need an employee on site, where older shops have an actual employee on site. So a lot of new institutional or even investors looking to enter the self-storage game, they're systemizing their process where they don't need an actual employee on site, electronic, making everything electronic, where they can make the same thing with the Airbnb, make that as efficient as possible and just collecting rent, which is the best part of being a landlord.
Yeah, I mean, obviously, like you said, the RTA and the LTB, they're definitely making it more and more difficult. And investors will always be investors at the end of the day. So whether it's commercial,
Right.
whether it's like, doing something different, we're going to find ways because I know we are resourceful. But I'll tell you, because I think, the storage facility has always been something of interest. but it is really difficult to find something that is actually for sale because I feel like a lot of the owners keep them forever. And then
Yes.
changing zoning on land to build is like almost impossible because you're not offering any jobs, like you said, right?
Right.
So, but like, what are you seeing? Like, what are you seeing? Like, you've probably seen a few come through on your end. Like, are these on market, off market? Are these new builds? Like these storage units, how do they come into people's hands?
So majority of our clients that we have, they're big clients across Canada, and they are a lot of it off market where they have the resources and the team. So these institutional industrial companies, they have a team of 50 employees, right? So it's not like a mom and pop investment company where they have people doing market research, market data, they're doing demographic analysis. Self storage is all demographic. Like we need people, like people in that area need to have are willing to spend additional money to store their product, right? So they have to look at discretionary income. So there's so much more data that is involved with self storage, and we're getting a lot of new construction as well, providing like heating and cooling services, maybe additional amenities to depending on the client they're trying to attract. But the clients that they're trying to attract are based on going back to demographics of that specific neighborhood. So a lot of it is off market, and some of them are buying land and redeveloping them into the self storage. So it's very difficult to compete with institutional grade real estate investors because they have so much manpower and so much resources. Whereas for us, we only have limited employees that we can hire, and we have only so much influence with the city in terms of where we can take the highest and best use of that property.
So they're also friends with the politicians, basically.
I don't know about that, but I'm sure they've done a lot of work with the city,
Yeah.
that they know how the city works, and they probably work with the city in terms of what the official plan is. So another
Yeah.
thing with commercial appraisals is that a lot of people think zoning is the highest and best use, but really it's the official plan of the city. So any commercial appraisal reports you look at, there'll be an official plan looking at the land use
Huh.
that determines what the highest and best use. So you can have an industrial zoning with a high density residential official plan, which means that if you were to buy the property that's industrial, you can rezone it to any zoning that meets that high and best use for high density residential. And the city will be working with you to get to that stage because the city wants to make that neighborhood to achieve those kind of development projects. So always look at the official plan. That's where you can make a lot of your money based on just flipping the zoning and selling it if the official plan makes sense. And you want to make sure your real estate agent's aware of that too, because if the real estate agent only listing it based on the zoning and not the highest and best use, they're leaving a lot of money on the table that the owner could make.
Yeah. Well, great insight. That was really good. So you're seeing a lot of stuff come into your plate or on your lap, and you're analyzing and you're appraising. Just in overall category. I mean, obviously, it's going to always be deal dependent, but overall category 2023 onwards, like, what do you think like are like some of the top types of investments commercial wise that you see the most opportunity with?
I think for myself, with the clients that I'm dealing with, industrial will always be the top of the asset class, just with the amount of businesses coming in and the amount of supply of products and these businesses that have to serve for a lot of these orders that people are buying, right? Transportation trucks, even land for to have transportation trucks parked, they're limited as well. So I think industrial will always be the hottest asset classes. Now, multifamily, I think we're not even at the end in terms of where the prices should be. With all the population coming, all investors are talking
Mhm.
about it. They have to go somewhere. Even though interest rates are high, ideally people still need a place to live. So new construction multifamily, that's probably going to be the biggest thing right now where people are um, trying to maximize the land of the building. So a lot of buildings that they currently own are not to the highest and best use. So they're looking to either add a very commercial building to the back or, demolish it and build upwards. So I think multifamily is a great asset class in new construction, especially. So if you can find opportunities where either redevelopment or land that can be developed, there will be your best opportunity right now.
Okay. All right, cool. What about yourself? I mean, you're also a real estate investor. Maybe just share a little bit of like what it is that you're currently investing in, maybe what you like to have in your portfolio.
Yeah, of course. So I started in 2019 October, bought my first single family home in Windsor for 257,000, which I wish the market was like that in
Yeah.
Windsor right now. And since then, I started getting into a multifamily. So once I got my first property, I've had to deal with my first tenant. I moved in, she stopped paying rent. COVID hit, you couldn't even visit the property, and I went through the phase of getting her out, not going through the landlord tenant board. We came to an agreement, and she left. After that, I started learning about vendor take back, creative financing, raising private money, which is like OPM. And I started understanding the game and how financing and valuation work, kind of put that together. And since October 2020, I've purchased slightly over 40 units in Sudbury as well as Windsor, and no JV partners. So I kind of followed the way Kelly and James, I know you guys were all in a webinar
Hmm.
with Henri on London. I was there too. Great. It was a great platform. And it was great to see everyone's perspective in terms of how they've been able to grow their real estate portfolio. I think for myself in the beginning, since I was able to get a lot of vendor take back, I was able to negotiate that on various properties, find lenders that are willing to lend with the VTB in second position. That kind of helped in my favor. So since then, I have my own employee in Sudbury that works strictly for me, my renovation team. And at this moment, I bought 8 properties in 12 months, about like a year ago. So right now I'm in my stabilization phase. So last year I've only bought 1. So I think I'm just trying to take it easy for a bit, get as much capital lined up, make sure I get some rental income in. Because a lot of investors think that just because, and it's a mindset game, you feel like if you're not buying, you're not doing anything, you know? So I'm just trying to get to that mental stage where you just relax, enjoy what you can, and then start planning ahead in terms of where you want to take your real estate portfolio.
Yeah, and there's nothing wrong with looking at your current portfolio and making it more cash flowing,
Right.
better, like repositioning it, like,
Yes.
and maybe your single family could potentially be a duplex conversion down the road or 3
Right.
units. Like, there's nothing wrong with looking at current portfolios and then taking a step back and like enjoying like what you've done because that's a lot of units in a very short amount of time. So that's great to hear.
Yeah, it's been a busy 2 years. So 2023 was a just stabilization year.
And with the VTB, I think that's also interesting in second position. So how do you negotiate a VTB in second position? Like, do you just ask them? Do you put it on paper, on the agreement of purchase and sale?
So a lot of mine were off market. I bought 14 units, sorry, 11 units that were on the market that I was able to negotiate a VTB through MLS. The other ones were off market. So for me is when I was first learning about VTB, then I started offering on it, especially off market. A lot of people thought I was a scam, especially when you ask the seller, hey, like, would you be willing to finance a portion of the down payment? But it was the way I was asking it. Like, you never want to offer a VTB till you hear the whole story from the seller. So, for an example, there was an off market wholesale duplex, a single family with an in law suite, which I eventually converted it. And I reached out to them. eh, w- They wanted 360. I went in at 330, got it under contract. But there's 2 facts that I knew that they wanted more money and they didn't get it. And number 2, and then the seller told me how during that time they were operating a gym and they needed to sell the property because the tenants weren't paying rent and they needed to cash out. So there were 2 things. There was one thing I know for a fact is that they would want more money because they need the money to support their gym that they have to liquidate. So I offered, I'm like, hey, like, you know what? Why don't I offer you 340,000? And if you were to secure 10% of 34, 340, so it would be 34,000, I would be willing to pay you 6% a month. And this was in November of 2021. And this will allow you to defer the taxes into the 2022 of that 34,000. So you're making more money on your interest, you're getting the money you need, but the 34,000, which you may not get now, you get to defer that tax into the next year in 6 months. So she actually countered offered at 350 for a 1 year BTP, but I knew that six months is all I need. So I was able to get it, got a credit union to fund 80% of it. I only had to put 34,000 and it appraised at 615, right? So I basically cashed out, paid her off, got a full burr. So during that time, I sold my single family in Windsor. So I had about $100,000. So I got this duplex. And then I came across a vacant 5 unit building and that was for 450. So it was a vacant turnkey 5 unit building off market. I just had to do the siding and the roof. So I was like, this is a huge opportunity that I don't want to miss, but I only have 100,000 and I didn't want to bring a JV on. So then I got the 34,000 secured. I went to the fiveplex and I'm like, hey, like, would you be, how much do you need from the sale? And they were like 400,000 because they had no mortgage on the property. And I'm like, you know what? I can offer you 10% if you secure 50,000 on the deal. And long story short, we were able to get that. Credit union funded 75%. I put in 14% and the seller put in 11% down. And when I bought 7 units with 100, I took a single family home that I sold and I bought 7 units. That 5 unit building, got appraised 2 months later for 715,000. But with the market taking a shift with the first interest rate hike in March of 2022, I decided to sell it for 790,000. Because at that point, I'm like, you know what, cash is probably the best thing, especially at the rate I scaled. If you don't want all your money tied into real estate, so I sold it, cashed out at 790, kept the duplex. So as of right now, I probably raised about 630,000 in vendor take back mortgages, and all of them have been paid except one right now. So I have about 160,000 that I still have to pay on my upcoming refinance.
That's amazing.
But sorry, one thing I want to add,
Yeah.
VTB is all about the value of the building, right? So you want to make sure your exit strategy is as solid as it is, because
Mm.
especially with the rate hike, you may not get the loan to value. Value is one thing. Loan to value on financing is one thing. So make sure you speak with your lender and then come to the appraiser, because you want to ensure that, yeah, you can get a $2 million valuation, but if you only qualify for a $1.2 million mortgage and you're buying it at 1.4 on the purchase, well, you're just going to have a lot of money tied in.
Yeah, because they look at, like, what, like, depends on, I mean, depends if you're a CMHC with MLI or not, but,
Right.
like, you're probably, like, at a 1.2 DCR, right? So, like, if your debt
Yes,
coverage ratio is, like, way off, then regardless of, like, what the appraisal comes back in, like you just said it, and you may not even get the value of it regardless, right?
of
You'll get
course.
whatever the lender can justify to give you. But I like your VTB story. I That's actually how we bought the resort, though it was actually on MLS. But we bought it for 1.1 mil.
Nice.
And we did a VTB in first position for 850 at 5% for 2 years. We ended up actually just getting private money and paid him out early.
Right.
But like, land is not that easy to purchase,
For
especially
sure.
raw land with a decrepit house. And so that one, I think we were all in like just under 3 mil, and then you guys like did your thing, appraised it at
Right.
4.7, and we just we used a credit union for the exit. So now we've got to bring in the income, bring in the money, but and that's phase one. So we'll
For
definitely have you
sure.
come back for phase
For
two,
multiple
phase three,
phases.
as we add more cabins and the main lodge and all that stuff. So,
Yeah. And I'm looking forward to that.
but no, that's good. That's awesome. So the next part of the podcast is the lightning round. I'm going to ask you 5 questions. You can give me the first answer that comes to mind. You ready?
Yep.
All right. So question number one was your favorite real estate investing book.
Ooh, I would say not real estate investing, but it would have to be Rich Dad Poor Dad. Just the first initial eye opening in terms of where I should take my life towards.
Absolutely. All right. Question number two, not necessarily real estate related, but do you have a favorite podcast?
Um, for me, it would be Canadian True Crimes.
Okay.
I'm not sure if you heard of it, but it's like a lot of horror stories, a lot of murder, like mystery and stuff like that. I love mystery. So for me, it's like for long drives, I do love enjoying that.
Awesome. Awesome. And number three, what do you do for fun?
I love playing sports. So typically basketball. I do enjoy nightlife in Toronto.
Mhm.
So just like trying new restaurants, going to a lot of bars, trying new drinks, and just like the whole nightlife scene. Maybe because I'm still in my mid to late 20s, I'm sure I'll be burned out by the time I reach the 30s. It's funny because a lot of my friends who are in their early 30s, like they're at 10 o'clock, they're done. And I'm like, hey, like why don't we just go have some fun and network? But the beauty of what I do in the industry, a lot of the people I hang out with, they're all in commercial real estate. So we're always meeting new people and building our network through that in terms of clients and market information. So yeah, we are having fun going to food, trying new food and stuff, but we're always gathering information and seeing what people are up to in their own place of work.
Very cool. I used to live in Toronto before I moved to Oakville, and I miss the food. I miss the brunches. I miss all the restaurants. Like, it's just like a whole
Yes.
other level that Oakville doesn't have.
Yeah. Well, when you come back to Toronto and try that, let me know. We'll definitely hang out.
Yeah, yeah, for sure. Awesome. Number four, if you lost everything tomorrow, all your money, all your assets, how would you start again?
For me, oh, good question. I think for me, I would go straight into multifamily commercial since I do have the knowledge I have right now. So it's probably starting to the 10 to 20 unit building, either get a creative financing, but also I'm in a position where I can leverage a lot of debt from private money instead of giving equity position away, and also deal structuring. So I think for me, we're getting straight into commercial multifamily and starting with that.
Okay. All right. And last question, if somebody has $50,000, they want to get started in real estate in some capacity, how would you recommend they spend that 50 grand?
First, I would say number one, 50,000 is going to be very hard for you to get 20% down in any secondary market in Toronto. So, oh, sorry, outside of the Greater Toronto area, um, unless you're in a very small tertiary market, I would say take 10% of it and get yourself into education, and getting into rooms where you get to meet people and learn a lot about what they did and how they scaled. And the remaining amount is either joint venture, partner with someone, or you borrow money with the remaining 20% down and you try getting your foot through the door and you start with a duplex, triplex, and fourplex, get a couple of situations, deal with the certain situation, and then once you get confident, start building and scaling.
Okay. All right. Awesome. Thanks for playing the lightning round. Myron, where can my listeners reach out and find out more or connect with you?
Yeah, of course. So Instagram is the number one platform I use to connect with real estate investors. So Myron Z, Myurenc. And even for commercial real estate valuation, reach out to me on social media and then we can connect, jump on a call. I actually have a link on my Instagram page where people can book a consult call for a commercial real estate valuation, for the project. Now, remember, it is not a coaching call in terms of people get confused. I'm like, hey, like I can't represent you from a coaching side as well as an appraiser side because it's just a conflict of interest.
Of course.
So it is strictly a commercial standpoint. And then I do have a coaching call section as well if you're looking to learn more about real estate scaling or anything commercial real estate related.
Amazing. Thank you so much for being on the show. Thanks for all the insights. And thank you for appraising our cottage at Inspire Beach Resort. We're like so happy that we found you and you had recently done another one. I'm like, all right, we got to get this guy.
No,
This
likewise.
guy
It was
to
great
start.
working with you guys and your team. So beautiful project. Can't wait to come back again and stay there. And truly, I think you're setting the stage for a lot of people looking to get into that because I wanted to go see what you've done and the impossible seemed possible, right? You just got to put your mind towards it. So thank you for all of that. And I'm sure you're inspiring a lot of people to get into that asset class and finding opportunities where they can build a portfolio for themselves in the resort space.
Awesome. Myron, thank you so much for being on the show.
All right. Take care. Bye.
Thanks so much for listening to Where Should I Invest with your host, Sarah Larby. Make sure to listen in next time. We'll catch you on the next episode of Where Should I Invest?